Most people know mortgages as the death pledge, but it's not all doom and gloom once you know the options. Let's talk specifically about buy-to-let mortgages. Well, first of all, what is a buy-to-let mortgage? Well, it's a mortgage for buy-to-lets, all right? So obviously in property investment, we are looking to rent out property over the long term to get some cash flow, and most importantly, the capital appreciation, the increase in value over time. But the secret sauce in property investment, compared to most every other investment out there, pretty much, you can actually use other people's money, including mortgages, debt, to leverage the property so you put less money in and get more money out. So this is how it works. The most typical loan to value, and by the way, you'll see this a lot, LTV, loan to value. And what this means is how much a bank or a lender is willing to put into the purchase compared to you. What's crazy, I think, is that it's 75% loan to value. You can actually get more. You can get 80 and 85% mortgages right now for your buy-to-lets, but 75% is the most common. What this means is somebody else will put in 75%, typically a lender, of course, will put in 75%, and you only need to put in 25% for this investment. Like, when you think about the logic of that, that is crazy. But the reason they will is because the investment is as safe as houses, as they say. And obviously it is bricks and mortar, it's physical, it's tangible, okay? It's not something happens tomorrow and the house has disappeared, your investment's gone to zero. No, it's still there. And the truth is, people always need a home. It doesn't matter if we're in a boom or a bust, people have lost their job, whatever it is, especially in the UK, the government will support you to keep a roof over your head. So it is one of the safest investments you can ever make, which is why the banks make most of their money by loaning out money for other people, just like you and me, to actually buy homes. And even better for you and I is that we can own more and more and more and more and more to accumulate our wealth. Now, there is some illegibility around this. There is some criteria. You cannot walk around, be jobless, maybe claiming benefits. Sorry if you are, you're not going to be able to get a lender to give you that money. You need to be reputable to some level. But it's not as hard as people think. A lot of people think, well, do I have to have loads of experience to get loans? Well, no, because it's very much like a job, isn't it? You need experience to get this job. Yeah, but I need the job to get experience. And this sort of tunnel that we all go through at the start of our career, property is not quite like that. Now, it does help if you own your own home, but it's not 100% required. There's hundreds, if not thousands, of lenders out there. What you need to understand is, I'll give you the perfect criteria, and then each criteria you don't hit is going to shrink how many lenders are out to help you. And it's important to understand that. What I will say is, everyone can get lending. I don't care if you've even defaulted on something, everyone can get lending, but the person that's defaulted on their last 3 loans, you're going to pay a lot of bloody money because frankly, you are higher risk for fairly obvious reasons. Whereas if you tick all of these boxes, you're good in the hood, you're going to get some decent lending on this. So loan to value, you're going to need 25% deposit. That's usually the biggest barrier, but 25% deposit gets you access to the whole of the market. If you put in less, like 20% or 15%, yes, there are lenders, but less people lending to you means they're going to charge you more for the loan. Number 2, if you are a homeowner, if you own the house already that you live in, I don't really understand it. I guess the fact that you've got some assets already, you've shown some reliability, some long standing, whereas when you're renting, you're quite short-term mentality. I don't know, but that's really going to help. And of course, you've got a salary. The perfect salary would be 25 grand. If you're earning 25 grand or more as a salary, you're good. You're going to be able to get access to a load of mortgages. That's the criteria around you. The ideal criteria around the property is really about rental coverage. Rental coverage is based on what they're loaning you, how much does the rent cover the mortgage, okay? The ideal situation is 125%. For example, if you have a mortgage payment of £1,000 a month, they're going to look for 1,250, so an extra 250 on top, and that 25% is the coverage that they're going to want. i.e. we want you to be making a good margin above so that we know we are getting paid. Now let's go into the types of mortgages. The one I'm not really going to dig deep into is the specialized mortgages like portfolio mortgages. But just so you know, the bigger you get as a portfolio landlord, portfolio being multiple properties, the more leverage you've got. So for example, if I go to Lloyd's right now and say, hey, I want a £10 million loan against my property portfolio, they will be a lot more flexible on how much they're going to charge me, the loan to value they're going to give me, and other terms of security and things like that. But most of you watching this, I'm guessing, don't have a huge portfolio on how to do that. So maybe a video for another time. Put portfolio lending in the comments if you want me to create content around that for you. Otherwise, I won't bother, right? The next thing is, am I going to go fixed, variable, or discount variable rate? Now you're like, what the hell is that? Well, you got three choices really. You can do a fixed rate, which is fixing the interest. So naturally, a bank, a lender is making money by you paying interest on the money that they're loaning you. You can fix that over a period. Now, please do not take any of this as financial advice. I am not financially qualified in any way. Some people will fix for 2 years and 5 years. I'll tell you what I'm doing. I am not fixing them right now. The reason for that is I believe, and fairly factual to be fair, that interest rates right now are going up for the one reason: to push down inflation, which is already happening. I'm not going to go into the economics of that. I've done videos on that you can watch already. So what's happening is, as the inflation goes down, it stabilizes and comes back down. So I believe this is it's painful, don't get me wrong, it is painful, but it's a very short-term pain overall, and then the interest rate's going to come down and stabilize, and then I'm likely to fix in about 6 to 12 months is when I'm looking to fix those mortgage interest rates. So that's option one. The next one is, of course, variable interest rates. Variable is when it goes up and down in line with what the Bank of England is talking about today. The downside of variable rate is you're feeling the pain as it's going up, but the benefit is once it comes back down, you can choose to fix at a lot more manageable rate, which will happen, by the way, but it's just a case of when, which I can't give financial advice around, unfortunately. The other type that you may not have heard about is discount variable rate. Did you know that a lot of lenders actually give a discounted rate for up to 2 years? And this is to help people in these situations. So actually it can be up to around 2% difference of the variable rate that you can get a discount on, but it's not forever. It's up to 2 years. And for a lot of people, it's a really good option, especially if you're investing right now whilst interest rates are a bit higher. So I can't go much more into it without crossing that barrier, but it could be one to look into. Now you might be watching this right now and going, that's great, how do I access these? Who do I talk to? Well, either you've got an incredible mortgage broker, and unfortunately I can't share the details of my mortgage broker on here, but an alternative is today's video sponsor, LENDLORD. Now if you watch the channel, you know that I don't just randomly plug people, it's people that I actually use. If you've seen me, I go through parts of my portfolio in LENDLORD. I just think they're actually incredible. I'm going to be honest, I would love to be a part of LENDLORD over the long term, right? They're incredible. You could upload your portfolio, you can manage your rentals on it, you can do so much. It's insane. You can find investment opportunities out there. But the thing I want to talk about is their access to market. So not only are they a direct line bridger, which means you can access to really, really quick money. And I've used them for over £1 million of my portfolio, by the way, over the last year or two. So I am an active user, but they've also got access to some of the best lenders in the market at privileged rates. So this is completely free, by the way. Obviously, if you take lending, they'll get a kickback, but using this platform is completely free, which I think is ridiculous, like absolutely ridiculous. And instead of me just singing their praises, if you don't use LENDLORD, check it out for free. I'll put a link in the description. I'll also put a link in the comment and pin it to the top. Don't take my word for it. Genuinely, this isn't like a 14-day free trial. If you use that link, It is completely free. Check it out for a month or two and let me know what you think in the comments. The other cool thing is the owner, Avi, know him very well. If you give feedback on what they can improve on, let me know in the comments. They will go and implement that for you. I've sung their praises too much, but genuinely, massive shout out. I think they're incredible. We use them, our investors use them. Check them out. Let me know your thoughts directly. The final thing I want to talk about is how it actually works as an application process. So what you do is you front load a lot of the information. What used to happen is you used to get a decision in principle, a DIP, or an MIP, a mortgage in principle, or there was another one, agreement in principle, AIP. They're all the same thing. So you used to go out, you used to get that DIP in place, and then you'd use that decision in principle to go around and put in loads of offers on properties and stuff like that. The problem is, I pissed off a lot of lenders because you go through a lot of checks. It was really bad for you because you got a hard search on your credit file. And so now what happens is you actually do some pre-analysis, you fill in your details. There's no hard search whatsoever. It's called a soft search. So they're just sort of checking you out, but it doesn't impact your credit rating. Then what happens is when you're ready to purchase property, you then submit your decision in principle. That's the one I remember most is DIP, decision in principle, MIP, whatever it is. So you actually get a formal offer or decision in principle for that particular property. At that point, there is a hard search in your application. So then if you looked on your credit file, it will say this lender checked you out. A lot of people are like, oh my God, that impacts me. No, it doesn't. If you're looking at like 10 or 20 different lenders, then yeah, that's going to look a bit suspect if all of them are looking at lending, because it shows people, well, why didn't they lend to you in the first place? But after 3 months, it goes down on the impact on you, and after 6 months, it just disappears. Okay, so please do not worry, and I'd rather say that because I think there's a lot of misconceptions. Once that application goes in, there's then a series of tasks and admin that the lender is going to do. One of the key parts of that is they're going to send out an independent valuer to the property. So this isn't like an estate agency valuer, which are not valuers, by the way. It's just a title that sounds good for marketing purposes. I'm talking about a RICS qualified valuer that goes down. RICS is Royal Institute of Chartered Surveyors. They are qualified professionals to value the property. Their word is gospel for the lender. Okay, that's really good and really annoying sometimes. So don't piss them off and get them a cup of tea when they go around. All right, keep them happy for the valuation. Once that value is back, you will get your official mortgage offer, and then you can draw down the funds. So if you want any more detail on that, just let me know in the comments. I could create more content or just answer your comment. But the cool thing about LENDLORD, and I mentioned them earlier, is all of this is managed in-house. So they will chase it for you, they'll push it for you, and get you the best rates for you to start building that portfolio. Now, let me know what you thought of this. It's kind of a slightly different video, I would say, to what I normally do, but I do think it's time that people understand what a buy-to-let mortgage is, the benefits of it. And just to finish this, a lot of people look at interest only versus repayment mortgages. I would say 99% of the mortgages in buy-to-lets are going to be interest only. And if you want me to do a video talking about why that is and the key benefits of why we only pay down the interest, put interest only in the comments and I'll create a video just for you. If you're new to the channel, by the way, and you want to find out more about buy-to-lets, property, mindset, anything you want around scaling up and becoming wealthy through this asset class, make sure to hit subscribe and the notification bell. And hey, if you did get value from this video, make sure to hit the like button. It takes you 2 seconds. Could have done it by now, by the way. And it really helps build the channel up and show people that this is going to be valuable for them too. I hope you did get value, and of course, I'll see you in the next video.